Hello, everyone. Thank you for joining us and welcome once again to the Wyoming Women's Business Center webinar series. Today we welcome back Kim Vincent for part 4 of the series entitled Preparing for Tax Time. I'm Sherry Annenson and the Executive Assistant for the Wyoming Women's Business Center, and I'll be your moderator. Kim is the co-founder and COO for Local Crowd LLC. She has worked extensively in both privately held and public service organizations and has worked as a business counselor for the Wyoming Women's Business Center and the Wyoming Small Business Development Center. This webinar is being recorded and it will be available on our YouTube channel. Just go to youtube.com and type in Wyoming Women's Business Center. Make sure to subscribe and check out our other recorded webinars. You can also go to our website, which is www.wyomingwomen.org. and look for us on Facebook. All participants are muted to minimize background noise, and if you have any questions during the presentation, please type them in the chat box. Now here's Kim, and I'll turn it over to her. Thanks, Kim.
Well, thank you very much, Sharon. Before we get started, I'd just like to check in with Roberta to make sure that we can hear her okay.
I'm here, Kim.
Oh, thank you so much. How are you doing? The technology can always be a little stressful, so thank you so much for joining us. I'm just really excited that you're able to be with us today as we talk about the tax season for our clients. So we've had some ongoing series about preparing financial information for your business and all the different tools that are available, and now we want to think about how that communication and the relationship with the tax accountant works, because we really do encourage people to have that professional on their team. So I'm really delighted that today we have Roberta Johnson joining us. She's a tax in-charge accountant at Anton Collins Mitchell LLP, and Roberta is one of those folks that's she's done a lot, and we originally connected with her when she was working at the Wyoming Small Business Development Center. She was a great colleague, and she was really busy going to school at the same time, and more recently she completed her master's in accounting, and she's going to be a great resource for us today. So the way we want to make this work is we're just going to go back and forth with some questions. I've prepared some questions that I think a lot of our clients would like to think about, and then we'll be able to open it up for questions from the audience. There is a questions box that if you want to go ahead and submit a question, I'll be able to ask Roberta towards the end. I'm thinking we're going to take like 20 to 30 minutes to talk about some of the basic questions that we have, and then we can move to questions from the audience. So let's get going here. And just to remind you, I always like to show this slide to celebrate some of the services of the Wyoming Women's Business Center. There's a lot of great things they can do to help you in your small business. We love working with micro enterprises. You don't have to be a woman-owned business. There are some great opportunities to look at some counseling services if you're planning a business. There's networking and educational opportunities, and there's some very specific tools to help you gain access to capital. So there, I think Cher mentioned the website wyomingwomen.org, and you can become a client there. You can sign up for classes there. There's just a lot of resources that you should take the time to check out. Just to do a really quick summary of what we've talked about and where we got to today is that, we've looked at all of the different financial, the bookkeeping, the accounting, the financial reporting, all the functions in a small business, and it can be really overwhelming. You're trying to do the transactions, recording all of that information, you're trying to generate the reports and look at some control issues in terms of going in, evaluating the information. Now what do I do with all this data? And we shared the notion of looking at key metrics for your business, and we talked about the best practices for financial reporting. So today we're going to talk about how do we share this information with our accountant, and do we need an accountant? And of course we always say yes, you do. And here is that lovely Roberta Johnson. So Roberta, we're going to go ahead and talk through some of the questions, and I'll give you a chance just to respond. And the slides will have the questions, and then we can go through your responses and see if anybody else has questions. And I'd ask that people just start submitting as they have the questions, and then I'll kind of watch those and see if we can interject them at any time. So for you as an accountant, what's the best way for your clients to give you their year-end information? How do you like to receive it from them?
Kim, we prefer to receive our information from our clients either via email, or we also have a portal that we have set up, and it's very simple for us to set up a spot in our portal for them to just upload and download files back and forth.
Okay.
So that's a really good way, and we do most of our stuff electronically. We've gone pretty much paperless, if you can say that, because there's still a lot of paper in the paperless world. But we will accept the information any way they bring it in, and it always depends on the size of the business. If it's a super small business, sometimes they don't even use the computer, so they give us paper, and that's fine too. If they can, we'd like to receive it electronically, because usually we can just take the numbers off of there and transfer it into our systems and be able to streamline the process a little bit.
So can you elaborate a little bit more now? When they're preparing all their year-end information, what do you like to receive? Can they just send you a profit and loss statement and you go from there, or do you require additional information?
We usually send out a list to our clients, and we like to receive a trial balance, which includes the balance sheet and the income statement. We like to receive the ending balance bank statement if possible. That way we can tie out those numbers and make sure that they're correct and there's not anything going on in those accounts that needs to be fixed or adjusted. We also like to receive the detail on any assets purchased and sales of fixed assets. Year-end loan balances is very helpful. A lot of people don't know exactly how to account for their loans and break out the interest and everything, and we are happy to do that as long as we can see what amounts we need to adjust, so that can be more accurate on the tax return. And then we also like to see a detail of the shareholder accounts so that we can see if there's been any changes made. Most of the time when we have a current client, when we get their information, we enter everything in, and then we make sure that the beginning balances that we start with match the ending balances that their prior year tax return was tied out to, so that we have clean numbers to start with, and we know that all we're dealing with is their current year information, because we don't want any additional stuff floating out there and affecting their current year tax return.
I love the term tie out. I mean, that's one thing I learned when I worked during tax season, is that there's so many ways that you yourself can verify your numbers in terms of going to third-party statements, whether it's, you know, all your loan transactions for the year that break out the principal and interest, or it's a credit card statement, or it's the 941s. It's so important that folks do take the time, because otherwise you can spend a lot of time tying out to all of the different resources. So I think that's a really good idea. Do all of your clients, are they using an accounting software, or do you see different varying degrees of the type of reporting they do?
No, not all of our clients use an accounting software. Like I said, it depends on the size of the business and how busy the business is, how many transactions they do a year. We have anywhere from clients that bring us in 2 pieces of paper that show their beginning cash balance and all their little ins and outs for the year, and their ending cash balance, and then their rent and expenses on another page, and they're super simple. We just enter them in from their little paper worksheet that they have. We have people that still maintain journals and ledgers by hand, and we have people that use QuickBooks or Quicken. So we have various degrees and levels of accounting knowledge among our clients, and we just have them bring it in the best that they can, and then we just go from there. So we set them up differently based on what information we get from them and how it's presented.
So is it acceptable for somebody to bring in that box of receipts for the year? I mean, that's sometimes the reality of it. We're just putting all those receipts away and not necessarily entering the information anywhere. Are you able to respond to that situation?
Yes, when we get that kind of a situation, what we usually like is for them to also request the bank statements for the entire year from the bank and bring those in as well so that we can get everything into the right places. It's really hard to recreate something when you just have receipts or bank statements because they don't give enough detail or as much detail as most people put into their books, like in a memo. This was for rent for this or that. A receipt sometimes has no description on it at all, and we have to kind of use our best judgment or call the client. And it takes a lot of time to recreate that entire year from bank statements and receipts. So we encourage people, if they want to minimize the cost of their tax return and the accounting expense, to get as much of it done ahead of time and to keep up with it. If you do it depending on the size of your business, if you have a lot of transactions every day, you would want to do it at the end of each day, or each week take like 2 hours and enter all your receipts and your income and expenses into your software or spreadsheet or however you keep track of it. And that way it's not so tedious at the end of the year trying to get all that information together.
So when we're talking about, they're looking at their receipts and making payroll, writing payroll checks, do you see some particular challenges that your clients are facing with how they're reporting payroll expenses? What issues do you see most often?
Most of the times we see things that are usually the people that are doing them by hand don't have too much of a problem because they only have a couple of people and they've been through a meeting with us on how to calculate the payroll and all that stuff. We have a lot of them that also don't want to do it, so they just have us do just their payroll if they're not comfortable with it. But most of the ones that we do see that are having problems are the ones that are not set up correctly in QuickBooks. So they're not canceling out the liabilities when they actually make the payment on the taxes, and that liability account on their balance sheet keeps growing and growing. And that's a big thing that we watch for when we get the balance sheet. If we see a payroll liability account that's like $30,000, we know that's wrong, because you should never have more than 1 month payroll tax, and the company only pays half of the payroll taxes. So it should be like our average person usually has payroll liabilities of like $1,300 at the end of the year, because they're 1 month behind. The December one hasn't been paid, and it won't be paid until January. So that's one thing that we try to watch for, because that happens quite a bit.
Are there other things that you see with in terms of reporting the payroll part of it at the end of the year?
Yes, a lot of times we also see where on our S-Corps they'll forget that the health insurance for them has to be included in the box 1 wages on the W-2. So the W-2 won't be correct, and we'll have to do corrections to the W-2s. Sometimes some of the reimbursements aren't classified correctly, and they'll just be out as an expense. So we do look at some of the expenses, and when we run the payroll expenses, we run the summary report for the year end, and then again we tie out the numbers to the W-2 and the W-3s and make sure that everything is correct and the amounts are tying out correctly. We do actually a hand calculation to make sure that those numbers are calculating correctly in the software or otherwise.
And sometimes I think when we're a sole proprietor, we probably shouldn't be including ourselves in the payroll piece or categorizing our payments as payroll. What sort of options do I have if I am a sole proprietor for paying myself?
We usually recommend that people figure out how much profit they're making, because lots of times when you start out you're not making a profit, so you can't take a salary. But once you are turning that profit and you are able to take a salary, figure out how much of a salary that you feel comfortable that you can make and do it regularly instead of just going, oh, well, I think, look, I had a great month, so I'm going to take a $5,000 salary this month or draw. It's better to figure out a regular salary that you take monthly, and you can classify it differently. Have payroll or employee payroll and owner draws or company salary or whatever you want to call it, but just keep them separate, and that way you can tell what you're paying yourself and what you're actually paying your employees. And then we also recommend that you anticipate the payroll taxes, because you do get stuck paying the payroll taxes on both sides for yourself when you're a Schedule C. So anticipate those payroll taxes and also the tax on that profit.
Yeah, I think that's really good advice, because it speaks to knowing what your profits are every month and tracking that, and not getting at the end of the year and seeing that you had $20,000 in income or net income and realizing that you have self-employment tax to pay. So I think it's great that you do plan ahead and kind of monitor that, so you can set aside the money for the anticipated self-employment tax. So let's talk about some of the common mistakes that you see people making. I mean, what piece of advice would you give them in terms of things to watch out for?
Well, some of the things that we watch for, and we do look at the detail. We don't go through, we count on people to do good accounting, our clients to keep good books themselves. And when you're doing a tax return, you're not auditing every single line item. So what we watch for is, once we enter the stuff into our software program, we usually do a comparison of the prior year and the current year, and if we have any accounts that have changed drastically, we look at the detail in those to see, well, is it really reasonable that that expense or that income item went up that much or went down that much. And then we also always look at, because it is scrutinized by the IRS so much, we really look at repairs and maintenance. Did they capitalize something that they could have just expensed? Did they expense something that needs to be capitalized and then depreciated over the next several years? So we look at repairs and maintenance, equipment and supplies, same thing. Did they buy a $5,000 computer and just expense it as a supply? So we look at, those are the most common things that people don't realize, the limits and the amounts that require capitalization on those. So lots of times they'll be either expensed, or we have the other extreme where we have people capitalizing a $50 chair. So we look for those things, and we try to do what is most beneficial for the client as well.
As a small business, what do you recommend for the cutoff? I mean, you could be expensing all those items, and and writing them off monthly on your P&L versus what item would I decide to capitalize? What's your recommended threshold for that?
Our recommended threshold is $500, and then for larger companies, or if you feel like your business, if it's useful, there is also right now a $2,500 threshold, which you actually have to fill out a form and elect to expense anything under $2,500 or $2,500 and under can be expensed if you elect to do so. But normally we stick with the 500 for clients that are super small, and then we've been doing the 2,500 on anybody average size business and up, or if they have enough income that we need extra expense to reduce it for the year and minimize their tax.
And what kind of non-allowable deductions do you see people including?
A lot of times we see them including things that are personal, like going to the grocery store or buying things offline, and it's not really for business use, it's personal expenses, or giving their kids money, paying for their kids' things out of the account. Sometimes vehicles, if they're not used, they may be expensing 100% of the vehicle when they should only be doing 50%. Things like that are the most common. And then
what about penalties? When, like, if you report if you do late payroll tax, if you're penalized either on, sometimes you see penalties on sales tax and sometimes you see penalties on payroll taxes. Are those deductible?
No, they are not. Any penalties or fines are not deductible, and yes, we do see that too, where they're trying to deduct, oh, well, I got a parking ticket and I was over here, so I'm going to pay it out of here, and it'll be in their expenses. And so we don't, and those are things sometimes that we can't always catch because that might be a little miscellaneous, and if your miscellaneous is usually around $150, we don't go through every detail again. So we count on our clients to make sure that they have things in the right places. And if they have any questions, though, we always encourage our clients, if they don't know where to put something or don't understand what kind of account it should go in, please call us. We are always happy to get you off on the right foot in doing something the right way than trying to clean stuff up later or having an audit and having stuff caught by the IRS going through it, and we didn't know because that's how it came to us, and we saw it for years like that, so we didn't go through it because it was so, you know, that there wasn't a huge difference in the expense from year to year, and it's not a high-risk category that we usually check, so we could miss that.
Well, let's talk about how, I mean, what are some real simple procedures and practices that you try to encourage your clients to do in terms of making that transition to the tax prep easier for everybody?
I always like to encourage people just to, when they're going through their books every year, to just try to keep up with them, and the more organized you are, the better. I mean, we do receive, like I said, people that bring in their bank statements and receipts or whatever, but there's even a difference there in how we receive the information. We've received everything from little wadded up receipts in grocery bags that are full and had to sit there and unwad the receipts and sort them and everything, to binders that have this month is this, and it's all really super nice, and there's a summary sheet that we can just pull the totals off of. If you keep your stuff super organized and there's not a lot of transactions, we're happy to do it by paper like that. The ones that are difficult are the ones that have a lot of transactions. Like you have a 6-page bank statement with over 300 checks that clear every month, and we have to enter all of those checks into a system to do every transaction for your business for the whole year for every month. That's going to take a while, and it would cost a lot.
And yeah, it sounds like that would be incredibly time-consuming. So if I can get really organized, I have to convince myself that accounting services are more than a luxury. You know, a lot of people feel like they just can't afford an accountant. And how do you respond to that? I mean, can you share what the real value that you provide your clients?
Mm-hmm. I think the biggest thing that I think is that our biggest value comes from our clients that come in and ask us for advice and plan ahead. Our tax planning is very well done. They come in, they bring us their QuickBooks that's up to date as possible, and our partners can go through and tell you what you need to do to save taxes. We just got done doing several that maybe you need to buy a big piece of equipment, and this year you made a whole bunch of money, so you can buy that equipment right before the end of the year and save yourself some tax this year, because the partner looked at your books and said, oh, look, you have a profit right now of this. This is about what the tax is going to be if we don't do anything. So here's some things we can do to lower that tax. And what we do when we get that is if you're on QuickBooks, or even if you're doing paper, we enter it into our system. And again, we make sure that that balance ties to the prior year, and that there were no adjustments made after the fact or anything like that. And then we look at it and say, okay, we have the right starting number, so this really should be what our tax is based on this year. And then if you have really high or low income, we can do some adjusting in the rest of your year to help mitigate some of those taxes by, like, buying equipment and expensing it, or maybe you're not making a lot and you bought a big piece of equipment. We can say, okay, no, you're going to want to spread this out over the next few years because you didn't do so well this year. We don't want to take a big loss. We want to just kind of even that out.
I think, you know, the thing that I see a lot of people doing really well is they do monitor the financial information for the business, but then they do reach out to the accountant to really have that expertise on their team, because you want that additional eyes on what's going on, I think, to provide some really valuable feedback. So if we were to budget for an accountant, what's a fairly typical amount that a small business should budget? I have a real simple 1040, or I just want you to do my Scheduled C for the tax prep work. What should we budget for that?
Like I said, if it is a pretty simple one and it is doesn't have a lot of cleanup work, it's been kept pretty well. Our starting point for 1040s with a Schedule C is anywhere from $450 to $550, and then it just depends on how complicated it is. If you have 3 businesses, it might be a little bit more, but really, it's with the changes in tax law every year, it's worth the peace of mind to have somebody even just come in, take a look at it, make sure that everything's in order, because we even have a hard time keeping up with all the tax changes, and we get emails daily on this is the change. And in the last couple of years, they've started doing really last-minute changes where we've even had to go back and change and amend some tax returns, and it's not the client's fault, so we do that and fix it and get them back in compliance, and they don't have to worry about those kind of things.
So what are some of the new regulations that you're seeing coming into play that are going to impact small business?
Right now, for this year, there weren't too many. Really, we have, like I said, we have that capitalizing on the assets and stuff like that, where you can elect to do the 2,500, where you can expense 2,500 in repairs, supplies, any kind of large fixed assets like that, instead of using the 500. Every year they keep changing the section 179 threshold, which this year it's 500,000. You can elect to deduct up to $500,000 of fixed assets in the current year. And then next year it looks like that's going up to 550. It's mostly those kinds of things right now because of what happened in the presidential election. We're not certain on how things are going to go. Our anticipation is that there are going to be some big changes with the Affordable Care Act. And there was also the one that was the new overtime rules, and those have been put on hold, and those we are pretty sure are going to go bye-bye.
So if I'm a small business, am I required, and I pay for accounting services, or I pay for my graphic artists, and I issue contractor payments, am I required to report that on a 1099?
Yes, anything that you pay a contract laborer above $600, you will, anytime you pay someone over $600, sorry, then you will want to do a 1099 for them if they are a contract worker. And accountants and attorneys, you'll want to do 1099s for them as well.
And when do I have to file those by?
This year, those are due by January 31st, and that is a hard deadline for all 1099s this year and W-2s.
At the end of this month?
Yes.
Okay, that's good to know. So we talked a little bit about depreciation. What are the rules for the mileage reimbursement and per diem for sole proprietors?
The mileage reimbursement this year, or for 2016, was 54 cents per mile for business-related travel. So anytime you go out to go visit a client or go on a business-related trip, then you can claim a standard mileage deduction of 54 cents per mile, and you can use map mileage, or you can use your odometer reading. Standard map mileage is easy to look up, and a lot of people like to do that because they forget to write down in their book. If you're traveling a lot, I would suggest that you do keep a book with your odometer reading, just because it might be easier if you had it sitting right there in your car and just wrote your mileage every time you were getting in the car and going somewhere for business, vice versa. You also have the option when you're traveling to use the per diem rates. And I usually go to, there's lots of different per diem rates for different areas in the country. Some of them are higher than others, and you can use those on, I go to usually OCONUS or gsa.gov to find those rates. And they run anywhere this year coming from $51 total, which includes breakfast, lunch, and dinner, and an incidental of $5, to the high end is $74 per diem per day. And that includes the breakfast is $17, lunch is $18, dinner $34, and then an incidental allowance of $5.
And when you do that per diem, is it still, does it still show up as 50% for meals, or you get to take per diem at 100%?
Well, you get to take per diem at 100% on your books, but when you report
Okay.
it on the tax return, you report it at 100%, but it automatically takes 50%.
Okay. All right. You know, what I see a lot of people asking questions about is like they want to, you know, they're a service provider to their community, so they donate time to their community, and they want to be able to deduct that on their tax return as a donation. So can you speak to that a little bit in terms of what kind of things they could deduct if they were, you know, volunteering or helping community organizations?
Okay. Yeah, I have a few clients that do a lot of that actually, and I have not looked at the rates this year, but they can deduct mileage for volunteer, for volunteer activities like Meals on Wheels, stuff like that. If you're driving meals around to people, you can also take travel expenses and hotels, things like that. If you go to a meeting, the cost of the actual meeting, things like that, you can deduct in the donation section.
Do you see a lot of times when you go to the, you know, your end of year trainings, they'll tell you what kind of red flags the IRS might be looking for when they're, you know, for potential audit activities. What are some of the red flags that people need to be aware of? Or do you know what I'm asking?
Yes, I do. We actually
Okay.
have our tax update upcoming this Thursday, so I don't know exactly what they're doing this year because it does seem like they kind of change it up a little bit every year to keep people on their toes, I guess. But the biggest areas that we do still see that are pretty consistently looked at are the 1099s. I know that we have had 2 clients that got audited because they didn't think that they were doing 1099s for all of the people that they needed to. So that is a big area. So do your 1099s if you need to, and if you need us to do them, we'll do them. We just have to have the information to do them. And then the repairs and maintenance, we do see them pretty closely scrutinizing those as well, especially now that they have the higher, the election to take the higher amount as an expense. They watch those pretty closely. So if you're doing, and you don't want to try to split things up, people do that sometimes. They'll have a remodel, and instead of capitalizing it, they think that because they made 4 payments of $2,400 that they don't have to capitalize it. But if it was one remodel project, it really does need to be capitalized for the full amount.
Roberta, we do have a few questions from the audience in terms of, the first one I think we want to clarify. When we talked about the budget, the $450 to $550, that's an annual type thing that they would invest in having their income tax prep done, correct?
Correct. That would be,
okay.
Say you brought in your Schedule C, all of your W-2s, everything for your current year tax return that had to be done with your 1040, including all the Schedule C information. That's just a one-time fee. That would be just the one-time fee once a year for that tax prep.
Okay. And another clarifying question is, I thought expenses were while traveling away, so you're out of town, are 100% deductible, and the meals locally with clients are the 50% deductible ones.
No, your travel is 100%. Meals and entertainment are always 50%. You can put them on your books at 100%, but the federal regulation only allows you to take meals and entertainment expenses at 50%.
50%. Okay, even if I'm out of town?
Any business-related travel is 100%, if it's for business, yes.
Okay, but not the meals part while I'm traveling.
Correct. Meals are, like I said, on your books.
On your books, but not
yes.
the tax. Okay.
Yes.
All right, so then that's where you'll see an adjustment on the tax return where it goes in at 100%. So I'm breaking out my travel expenses by airfare, lodging, and meals, and all my meals will get added up at 100%, but then it's 50% is deducted on the Scheduled C.
Correct, because we'll put it in as 100%, but the tax software automatically takes that down to the 50%, and then it does do usually a little printout that shows what the difference is, that the difference is because of that 50%.
Okay, and then we have a couple comments about the actual per diem. So one client is doing it, on Google Sheets, and then they're importing their mileage, tracking their mileage into Excel. So I think that's a really good practice because then you can get a really good number. And then the charitable miles are 14%, 14 cents per mile driven. This is for 2016, and then 54 cents per mile for a business mile. So thank you for that input. Question about the 1099s. So the 1099s is if I have somebody that I paid $550 to, I'm not required to issue a 1099 to them.
Correct.
It's when I hit that $600 threshold that I have to do it. Okay.
If you have somebody that's $599, you do not have to do a 1099 for them. But once you hit that $600 or more, they need a 1099.
Okay, and then do you have, can you kind of outline the process for, I want to create a 1099, what do I tell my contractor? I give them a form and they fill that out and then I issue the 1099? What does that look like?
Yeah, usually you would have probably a W-9 on file for that independent contractor. And then in on QuickBooks or wherever you keep any payments that you made to that person or that vendor, you would add the total of all of those payments up for the year and then fill out the 1099 for them.
Okay, because you do need to have their taxpayer ID when you're, so it's the business that generates the 1099 and you have to have that contractor tax ID number to do it.
Yep. Yep.
Okay. All right.
And
very good. And
I know that last year they were being super picky about having the correct address as well.
Okay. All right. And here's another question. Accountant versus CPA, which one is preferable? Do you see a real difference?
Just that they haven't taken the CPA exam.
Yeah.
It depends on.
You just want to look for, I was going to say someone that has experience in your industry, and
yes.
You really want somebody that understands, the type of business that you're doing, because there are some specialty things that can be going on with the service-based versus retail, and knowing the regulations in that area.
Yeah,
an accountant is an accountant.
In a specialty industry, like we have several clients that we just took on last year or the year before, and they're doing drilling overseas, then you're probably going to want to go to a CPA firm and find somebody that specializes or has experience in doing international stuff. and have some expertise in the drilling industry and stuff like that.
Yeah. And really the CPA is just, I mean, you're certifying yourself as a public accountant versus being credentialed as an accountant, you know, with the degree or the experience.
Right.
So one more question, and I think a lot of small businesses, you know, struggle with this question. So this is a small business, they're in their first year of filing, and they really want to understand how to pay themselves as they go forward. It's a husband and wife owner, and it's all new to them. So can you talk a little bit about when you're a sole proprietor, your Schedule C recognizes your net income, and if we haven't done any draws or anything during the year, how does that income get reported? And how should we pay ourselves? I mean, you spoke to this a little bit in terms of scheduling salaries, but is it a draw or a salary that I'm doing?
People call it different things. It would be, you can call it whatever you want, but you would be taking, basically just taking some of that profit as a salary or a paycheck, or paying yourself from that profit. And then you have to, in addition to that though, you have to pay both the employer and employee portion of the tax on that gross amount of salary that you took.
And so we're paying it on the net. I mean, the net in as a Schedule C, my net income. Then I have to pay self-employment tax on that.
Correct. So whatever is
okay.
left after you do all of your income and expenses, which includes the salaries and anything that you took out, then you would pay tax on the difference between all of that after taking out all the expenses.
And I think that's where a lot of people get into trouble, is that they're, you know, we want everybody to be profitable, but at the end of the year, when you know, put all that information in your Schedule C, it's gonna calculate self-employment income or self-employment tax if you do have positive income. So
right.
it's really important to be aware of that.
And that is a lot of people that are new to business don't understand that, because they've always worked for someone else and they're taxed just on their portion, and the employer has always paid that portion, and they don't understand that on the Schedule C that it calculates based on that net income amount, and that you get a credit for 1/2 back, but it doesn't really make up a huge difference.
But I mean, it could be a big amount if you had like $10,000 in income.
Yeah.
You'd find yourself with a tax bill. So I have a question that I didn't ask you earlier, but you know, when a lot of people are sole proprietors and they're thinking about, well, I'm going to become an LLC instead, can you share with us, do I still have to get liability insurance? Have I totally protected myself just by incorporating, or am I still, if I transition to a single person LLC, what do I expose myself to?
Well, a Schedule C, you're responsible for any liability for the business and personally as well. So you're responsible for all of your personal, like your home, everything can get taken into account to cover anything for that Schedule C. The same thing for a single person LLC. Unless you do a limited liability, then your assets, your personal assets are still taken into account, and they can go after those. And so we usually do a client by client basis. Once you get to a certain point, then we recommend, I don't usually do that part of recommending where someone, usually the partners are involved in that. When somebody starts doing a certain amount of business or a certain level of business, then they recommend that they do a partnership or an S Corp, and that they do the limited liability or vice versa.
Mm-hmm. Wow, lots of great questions from the audience, so we really appreciate that. And Roberta, thank you so much for taking time to be online today. I'm going to make a quick, just a quick question. The 1099 is going to be per contractor over 600. It's not the total, but it's per every person that you paid that received over 600. And then you also file a form that summarizes all your 1099s.
The 1096.
Okay, and then that's paid over a year, so it's whatever your tax filing year is. Those are the people you need to report the income for.
Correct.
And then one last quick one. Example, if there's multiple transactions at $450 during the year from the same contractor, is a 1099 required? And it sounds like yes, it is. It's the total that you pay to that contractor per that EIN.
That's correct.
Okay. All right. And so if you do have other questions, feel free to contact the Wyoming Women's Business Center, because they have resources there that they can hopefully address some of these issues and answer your questions. And again, Roberta, I really appreciate your time today. I know you're jumping into your super busy time of the year, so thanks for being on with us. And we're going to go ahead and sign off.
Thank you, Kim.
Yep. Bye-bye.